Good morning, everyone. My name is Carrie Ramsey, and I'm the project manager for the Weekend Project, which is led by Queen's University and funded by FedDev Ontario through the Women Entrepreneurship Strategy Ecosystem Fund. Welcome to you all today. It's so great to see some new faces, some familiar faces. I think we've now done about 50 of these virtual workshops since COVID began, and it has been a real thrill to get to know a lot of women entrepreneurs better, whether you're in our region or outside. So welcome if it's your first time, welcome if it's your 50th time. We're so excited to have you here. And today, of course, we're speaking about incorporation. And it's an exciting topic, I think, for any small business to be considering. We have an expert in our midst, Cara, who's going to take the virtual floor in just a moment. But before we do that, I would love to invite you to share with us in the chat where you're connecting from. If you could let us know geographically where you're from, maybe even tell us the name of your business so that we can get to know you a bit more. We'd love to use these opportunities, not just for learning, but for networking as well. So please do let us know as I continue to let folks in from the waiting room. While you are taking a moment to let us know in the Zoom chat where you're connecting from, I'll take a moment to just mention that I'm connecting to this workshop from the Bay of Quinte region, which is the traditional hunting, gathering, and fishing territory of the Huron, the Anishinaabe, and the Haudenosaunee peoples. This is actually traditionally known as the dish with one spoon. I'm not sure if you've heard of that term, but it's a concept that the Indigenous peoples created to really explain or help us visualize this idea of sharing and making sure that when we take, there's enough left for others, because there is only one dish and we're all eating from the dish, a same dish with one spoon. And I think it's a beautiful concept when we consider the ecosystem that I just mentioned in a couple minutes ago, talking about the entrepreneurship ecosystem. Sort of this idea that we are symbiotic, that we are all in this ecosystem together and we can all learn and share. And today, Cara is sharing her wisdom. Thank you to Cara. And we're all mutually, I would say, benefiting from this experience. So I think that there's a beautiful applications for that Indigenous concept of the dish with one spoon. So watch throughout your day for ways that you can apply that concept as well. So welcome to everyone. Thank you for those who have been sharing in the chat where you're connecting from. If you're just joining us, please do take a moment to do that. You can express your questions in the chat as well. This is only a 1-hour session today. I want to signal that to you. It will be recorded. So if you would like a copy of the recording, I'm going to put my email into the chat to make sure that you can get a copy of that recording later today. Without further delay, however, let's get into the good stuff. Cara, I'm going to turn the virtual floor over to you. Thank you so much for joining us today.
Thanks so much, Carrie, for having me, and thanks for everyone for attending. I will introduce myself shortly, but Carrie's going to watch the chat sort of as we go. And I'll give you my background, but I can talk about this topic for hours and hours. So, please feel free to interrupt and post a question in the chat if you have a question. I'll try and check back periodically throughout to address questions. Typically people learn the most from asking, a little bit about their experience and sort of applying it here. So hopefully everyone knows why they're here. We're going to talk about incorporating your business. And I'm not a lawyer. So I generally would work with a lawyer, a commercial lawyer who would help and assist you in the incorporation process. But a lot of people talk about incorporation from a tax perspective. So we're going to touch on why you might do it from a business perspective, but we're also going to primarily talk about it from a tax perspective. So here we go. So I'm a partner in our Kingston MNP office. I'm also an incorporated professional as well. So I have 2 corporations myself. One is my partnership. I hold my partnership in the MNP partnership. And the second one is actually, I do a lot of work with CPA Ontario, as well as students training to become CPAs across the country. And so I write some cases, I mark cases, I teach for various consulting firms. So when I talk about incorporation, I work with a lot of local businesses in Kingston who are incorporated or who are not, but I also have my own incorporations. So, when I'm filing my own T4s and making sure my own tax return, right? Shoemakers' kids, I'm always meeting that deadline right at the very end, but I also work with my clients to make sure they're well in advance of those deadlines. I'm also a Queen's grad as well. In terms of M&P, so this is just some background about M&P itself. So we're a collection of CPAs across the country. Not all CPAs, not just accounting. So we do, this is our little promo. We do, I work primarily in assurance services. So I work in audit, review, and notice reader, and as well as compliance tax with a lot of my small businesses. But we have lots of other service lines as well. So that'll give you some information about us. In terms of agenda today, this is what we're going to talk through. I'm not going to go through each line item, but really the key thing here is if you are not incorporated, this is going to be valuable in terms of should I? And then if you are incorporated, it might give you some information around planning with your corporation. This is in almost every presentation I ever do. These are the Ontario marginal tax rates. So I will refer back probably to this slide a couple times when I talk about tax benefits. This is the tax rate. So some of these this is 2020 marginal tax brackets. So it's federal and provincial tax brackets combined together. That's why you see some of these tax brackets are really small. But for people who aren't familiar with how income tax works, when you're so we in Canada obviously are taxed as individuals. So you can earn about $12,000 to $13,000 of business income, net business income, or salary, or interest income, and you can earn that without paying any tax, essentially, other than Canada Pension, which is not a tax. But anything above that, we have a marginal tax system. So in this example, from 10,000 to 12,000, the tax rate's 5%, and from 12,000 to 44, the tax rate's 20%. And then so on and so on. So some people think, I had a great year, I made $200,000, I'm going to pay 50% tax on everything I make. That's not how it works. You're going to pay, that 5% on the first little bit, then the 20%, then the 24%. So our system in Canada is a marginal personal tax system. Okay, so I will refer back to this when we talk. So, if you're in those high tax brackets, the tax rates are pretty significant, right? You're looking at 45 to 54% in Ontario. We are actually the second highest tax province, just so you're aware. We have the second highest tax rate in the country. If you're in Nova Scotia, you're number one. All right, so should I incorporate or not? So for anyone right now who's not incorporated, so you're running your business, you're probably a sole proprietor or maybe a partnership. So what's happening is if you're a sole proprietor, you're just claiming on your personal tax return, you're claiming all the business revenue and all the business expenses, and you're paying tax on the net number. So you sell $100,000 of goods, you have $40,000 of expenses, you make $60,000, and you pay tax on that $60,000 using those marginal tax brackets. Okay, so in terms of incorporation, I have four main reasons why you may want to incorporate. Number one is always the business reason. So if there's a business reason for you to do this, the tax reason is always secondary, right? Like some people will come to me and say, I should incorporate because I'm going to save tons of tax. Well, maybe, maybe not, right? But if there's a business reason that you need to incorporate, then yeah, maybe you should. That should drive it, really. That should be decision factor number one. And some of the business reasons might be potential legal protection. And again, you should talk to a lawyer as well about that. But if I incorporate you're generally going to see, for example, a construction business is going to be incorporated because they have some significant business risk, right? If someone gets hurt on site, if they, build a house and something falls apart, by incorporating that business, they can somewhat limit their liability as a person. So if I sue, if they build my house and it falls down, I'm going to sue the company. And so in a lawsuit, I might try and sue everybody, but in theory, the directors or the owners of the business have some legal protection, right? If they're, breaking all the rules and not paying the bills and all that stuff, then, they can potentially pierce that corporate veil and we can lose that protection. But, if they're running their business the way a business should be run and they've got everything in the corporation, then the corporation's like the boss, right? It's separate from me. So you're going to sue that corporation. You are going to get limited in certain professions. So depending on your profession, if you're a professional in any way, and the professional, everyone's a professional in my mind, but if you're defined under the Business Act as a professional, you're generally going to not be able to protect yourself legally. And so that would include like lawyers, for example, accountants, veterinarians, doctors, dentists, massage therapists, chiropractors, anyone who's basically governed under a college is not going to get the legal protection. You can incorporate, but if you mess up, you're still going to get sued personally. The other thing, if you want to protect the name of your business, right? By incorporating, it is a little bit easier to protect the name. So if I want to have my own business and call it, Cara Chesney Rainbows and Sunshines, right? I can incorporate and I can protect it a little bit easier with a corporate name. And then incorporation makes it a little bit easier sometimes to bring on investors. So your business is growing, and now you want to bring on other people to get involved in your business. Incorporating, you could potentially make them a shareholder of your corporation. It gives you a lot more flexibility in terms of bringing on shareholders and potentially getting rid of them. The last one I had here is some contracts. I'm seeing some contracts like government contracts or international contracts, especially if you're doing any work in the US. Sometimes they want a corporate entity to do the bidding on those contracts. So again, these are all business reasons why you might do it. It has nothing to do with tax. So if I have a client that comes to me and says, I really want to limit my liability, I'm starting up this new business and I'm concerned, I'm going to give advice and I want to be protected, that should drive the decision, right? That is decision number one. Okay. The next ones are the three next reasons are tax reasons. Okay. So I'm going to talk quickly about a concept of tax savings versus tax deferral. So tax savings is a tax you never pay. And so when we talk about those marginal tax brackets, a tax deduction is going to save you tax. Okay, so like RSP contribution, you make that $60,000 in your business and you do an RSP contribution for $10,000. You're going to pay tax on 50, right? So that's a tax you basically won't pay, today. So the key thing with a business is making sure from a tax perspective, you get all your expenses. Like I have clients that will come to me and say, I need to hire someone new, so I don't pay any tax. Well, okay, well, do you need to hire someone new? Well, no, but I don't want to pay tax. Well, that doesn't make sense, right? You're going to hire someone, pay them $50,000 so you can save $20,000 in tax. Doesn't make any sense at all, right? But if you need to hire someone, that's a business decision. But the key thing is making sure you get all those expenses, like having good bookkeeping to make sure you're not missing any expenses, because every expense you have is going to be a deduction and it's going to reduce the tax you pay. So that's sort of the key thing to do in terms of saving tax. A tax deferral is tax you save now but pay later. And because in Ontario and in Canada we have a marginal tax rate system, this is why an RSP might be good, right? You get a deduction today when your tax rate's 50%, but you pull it out of the RSP when you're retired and your tax rate is 20%. So there's permanent tax savings in the difference, but ultimately you will pay some level of tax later on. Okay, so tax savings is never pay the tax ever. Tax deferral is pay it later, but hopefully at a different rate. So reason number two in terms of incorporation is what we call tax deferral. So marginal tax rates, right? So I showed you if you're in the top marginal tax rate, your tax rate is almost 54%, okay, above 220. In Canada, we have what's called the small business or Canadian corporation and a small business deduction. The small business deduction in Ontario, which is the combined federal, is 12.2%, flat on $500,000. So all your money goes into your corporation, all your expenses get paid out of your corporation, and if you make $500,000 or less, that first $500,000 is going to get taxed at 12.2%. Okay. Then anything above the 500 gets taxed at 26.5%. So in theory, we have tax deferral, right? Because the money left behind in the corporation could be invested. And maybe you're investing it to buy new equipment, to buy a building, to have a storefront, to buy manufacturing production equipment, right? So, you personally, I always use the top tax bracket because it's easy, but, if you're personally in a 54% tax bracket or 53.53 and you make $100,000, you're going to lose more than half of it in tax and you're going to have $46,470 to invest. If you're incorporated and your corporation makes $100,000, it pays that 12.2% tax, and now it has $87,800 to invest. So that's tax deferral, because ultimately you're going to pull the money out of the corporation someday, and hopefully way in the future, and hopefully at a lower tax bracket than you're in today, not at 54%. but it's tax deferral. And so if you're expanding your business and you're taking on, for example, loans, I'd rather have $87,000 to repay my loan than $46,000 to repay my loan, right? So there is value in doing that corporation. And that's why we have that 12.2% tax rate, is to allow businesses to essentially grow faster than if you had everything in your personal name. Okay, does that all make sense, hopefully, so far? Not seeing any questions. The third benefit is potentially income splitting. So a lot of people will say to me, and I'll have clients that come in and they're like, oh, I'm going to file jointly with my spouse. Actually, in Canada, we don't have that system. So in the US, they do. So that's why I think there's a perception for people to think that I file together. We generally, you and your partner would typically file at the same time together, because there's certain credits that you may want to share, or one of you is only entitled to. But we don't have the concept of joint income. So we don't add your two income together, you and your partner's income together, and then figure out your joint income. The US does have that. So it's based on an individual person. So all those tax rates I showed you is based on my income or my partner's income. I pay tax on mine, he or she pays tax on theirs. So there's a concept of what we call income splitting. So if you have this corporate box and all the money pays in the corporate box, and if you're not governed by any rules, any regulations in terms of your profession, then you can make whoever you want a shareholder, right? So your partner, your kids, your parents, we see, that's what I see most commonly. Your business partners, you can bring on investors, and all the money goes in the corporate box, and then everyone who's a shareholder could have what we call a dividend. So we'll talk about compensation later on, but you could pay out a dividend. So for example, if I'm, I'll give you an example. If I make $220,000 and so I make 220 and my partner makes zero, I'm going to pay lots of tax and my partner's going to pay none. Okay. If I incorporate and I put that 220 in the box, and then we each take out 120. So we're still taking out, 110. So we're each taking out 110. We're still taking that ability to do that on an annual basis is about a $36,000 tax savings, because I'm using all the marginal brackets of both of us rather than all mine and none of theirs. So we use, 2 years ago, 3 years ago, we would do this a lot. So even if you said to me, we need every dime we make, we need to pay our bills, and we need groceries, and we got childcare, and I would probably still incorporate you just to get the ability to do that income splitting and use your partner's marginal tax rates. Obviously, your partner would have to have limited income, or your kids above 18. We would do that. We would pay them a dividend, and they'd go to school. There were new rules introduced in 2018, and that's called tax on split income, which does significantly restrict the ability to do that. So if you and your partners, you and your spouse, you and your children, whoever your business partners are active in the business on a regular basis, then you can still do that. So if I start a business with my partner and we're active in it on a daily basis, we're running the storefront, I can still income split. So you can still do that. There's some other exceptions as well, but generally the people who are getting dividends have to be active in the business if they're related to you. Okay, so if you bring on a related party who's going to be a shareholder, they need to be active. If it's not a related party, you're bringing on a third party who you're not related to, then you can basically do whatever you want. Okay, but you are restricted in terms of if it's related to you. So the ability to do that, where we used to do it 3 or 4 or 5 years ago, got shut down, essentially. The other thing to note here is, some people say, well, I want to incorporate so I can pay my mother a salary to do the bookkeeping. You don't have to incorporate to do that. You can always pay a reasonable salary to anybody who's doing any work for your business. So that shouldn't be a driving, you can have salaries without being incorporated, right? You can hire employees without being incorporated. So that's not a driving decision for incorporation or not. In terms of salaries always have to be reasonable. So they always have, what would you pay a third party? So I have clients who will say to me, well, I want to pay my mother $50,000 to do bookkeeping. And I was like, I'll do your bookkeeping for $50,000, right? So it always has to be reasonable. In terms of dividends, There's no reasonability test on dividends, other than if the person who's getting the dividend is related to you, then you have to look at whether they're active in the business, but there's no reasonability test essentially. So that's why we sometimes like dividends over salary, right? I can pay you $100,000 in dividends this year and 0 next year and 50 the year after and whatever we decide. Okay, so income splitting is the second main one. The fourth main one is if you think you're going to sell your business. So we have this concept in Canada called the qualified small business, called capital gains exemption. So if you are a sole proprietor and you just sell your business, so you sell your equipment, you sell your goodwill, you're going to pay tax on that at whatever your marginal tax rate is. So, and some of it might be capital gains. So capital gains right now are taxed at half of those rates I showed you at the start. But you kind of have no control, right? I build up this business, I'm self-employed, I sell it for $1 million. Well, now I probably have $1 million of income on my tax return all at once. Okay, and all at once isn't great because you're going to lose half of it to tax essentially. So we have this concept of the qualified small business, I keep saying that, the capital gains exemption. So if your business is a qualified small business corporation, you can actually sell your shares of your corporation. So you incorporate the box, you're a shareholder. You can sell those shares in 2021 for almost about $900,000 and pay no tax. And that's $900,000 per shareholder, assuming that you've never used your exemption before. So everybody in Canada actually, from the day of birth, has this lifetime capital gains exemption. It started out years ago and it was at $800,000 and it indexes every year. So it goes up very slightly every year. So I think last year was 886. So it's 892. And that's the ability to sell shares of what's called a CCPC, a Canadian controlled private corporation. So you can't buy shares of Amazon and sell those and use this. It has to be shares of a Canadian company, privately held, so not traded on a stock exchange, and it has to be active activities. So if your business just holds a whole bunch of investments, it's probably not going to qualify. So it has to be an active business. So, active business is pretty broad, but essentially if you're getting that small business limit, that 12.2%, you're going to be considered active. So I presume most people's businesses on here would be active. So like my consulting business is an active business because I'm actively doing something to manage it. So you need to sell shares for this. There's on the slide, there's a couple points in terms of when you go to sell it, you have to meet some certain tests. So you have to have active assets. You have to have owned the shares for 24 months. Most of the business assets themselves on the day of sale have to be active, but active assets is the equipment you use, inventory, receivables in the business from your customers, and your goodwill. So the fact you've built up, a brand name, trademarks, all those things would be considered sort of goodwill. So this doesn't get used a ton just because everyone thinks, so first I have clients that think they can use it on anything they want. You can't, you can only use it on the CCPC shares. The other thing is it doesn't tend to get used a ton because if I'm a buyer of your company and I want to buy your business, I don't really want your shares. And they're because if I get the box with the company and I get the shares, I get every problem in that company that could exist, right? So if you have employees in there that I don't really like and I don't want to keep them on and I buy the box, I'm getting all of those problems. If you didn't really do a good job at your bookkeeping for the last, 6 years, I'm buying the box with bad tax returns that are filed and bad bookkeeping, right? So if the CRA comes back, I'm going to inherit that liability. If I buy the box, I'm getting all, the lawsuits that are maybe out there, right? So as a buyer, I generally don't want the box. It depends. We see it every once in a while. It depends on the type of business, to be honest. So as a buyer, what do I want? I want the assets. I want to pick and choose, right? I want this inventory and I want that equipment and I want those employees, but not those employees. So what ends up happening is as a seller, I want to sell the shares because I want to get this capital gains exemption. But as a buyer, I don't want your shares. So that's a negotiation. So, what typically happens is buyer figures out what the seller's going to get after tax, and will offer more to buy the assets. Or we reduce the price and we buy the shares. So it does depend. We do see that. I actually have seen this. I've seen this twice in the last 3 months. One was selling a retail business, so very limited risk in selling a retail business usually. The second was actually, we're seeing it on a campground. So selling an active campground, buying, really we're trying to get, the seller's trying to get access to the land, but the seller is going to be able to use their lifetime capital gains exemption. Most of the sales I see though are asset sales, just because of the risks. Okay. All right, so there's some other quick advantages around this. So if you're incorporated, remember the box, right? So you incorporate your business, the box, you become an employee again. So if anyone was ever an employee before, now you become an employee of your own corporation, which is a little insane. But as an employee, you can control, all the money goes in the box, all the expenses for the business get paid out of the box, and whatever's left over, you can decide what to do with. So it's a little bit easier, I find, for some people to budget themselves, right? So, if you're building up capital, you would take a salary out of your corporation and you remit the taxes, and you're not surprised at the end of the year by had an amazing year, now I owe 40 grand in taxes that I wasn't expecting. So you become an employee again, is essentially what happens. The other thing I've put on here is SHRED. So that's scientific research and experimental development. So if you are doing any sort of SHRED development, and SHRED, as defined by the CRA, is any technological uncertainty you are trying to solve and develop a product or a service out of that. I have a client, for example, who's trying to so they're developing technology to clean off solar farm. So you see those big solar farms. Well, what happens in Canada when the snow lands on them? They're not very good, right? So they're trying to develop technology to efficiently and quickly clear the snow off of solar farms. It's kind of a northern hemisphere problem, right? A lot of the farms in certain countries are not going to experience that, but that's a technological uncertainty. We don't have good technology that does that. So, they're going to get what we call SHRED credits. And so SHRED is better in a corporation than it is personally. You get more money is essentially what happens. You get about 20 to 30% more. You have to have expenses. So in that case, you might have salaries. You might have not equipment, but supplies. So you do get a percentage of that, and that's refundable. So you actually get a percentage of it back. It's around 35%, depending on what it is. So you spend $100 in salaries developing that technology, you get $35 back, and it's a better credit when you're a small business corporation. Okay, so that's another one. The disadvantages, obviously, so increased legal and accounting fees. So I'm going to talk a bit about administration, but it's more expensive. Increased paperwork, and there's no benefit. So I have a lot of people that come to me and say, I'm going to incorporate, I'm going to save lots of tax. And I say, well, are you spending every dollar you make? Yeah, I am. Well, you're actually not going to save any tax, but I'm going to make more money as your accountant. So, absolutely, I'll make $2,000 more a year, but you're going to be out $2,000 more a year. The reason behind that is in Canada, it's called integration. So basically what it means is if all the money goes in the box and then you take all the money out anyway as a dividend or a salary, then you pay the same taxes if you had never incorporated to start with. So there's really no benefit of just incorporating just because you think you're going to save tax. Okay. All right. So I do see someone posted a question around the advantages and disadvantages of a corporation versus a cooperative. I don't know that answer, actually. I don't have any clients that are a cooperative. So I apologize. I'm not going to be the one to ask that question in some cases, I know a cooperative is treated like a partnership and everybody pays tax on their income, but I don't know anything else. In terms of when is the right time to incorporate it. So again, the business reasons always need to be, if there's a business reason to do this, you should do it, right? If it's going to cost you $2,000 more a year to have your compliance, be in line in terms of compliance, it's probably worth it if you're protecting your home and your family, right? If you're taking on significant business debt to purchase assets or goodwill or investing in working capital, so you're buying lots of inventory, you're going to have receivables. because remember that deferral concept, you'll have more money to repay the debt. You'll have more money to invest in the working capital if you're incorporated. When your living needs are less, so you don't need everything you make and you can leave some behind. Now it might make sense. Or you're looking at something like shred. All right, so administering. So unlike a sole proprietorship, a corporation is a separate legal entity, which I already talked about, and it is separate and distinct from the individuals who own it. A corporation does not die. Corporation will live forever and it will outlive you, assuming you fought. So the CRA can shut you down if you don't file for a certain number of years. So that's one way that it can get murdered. But generally it's going to live forever. So it's separate from you. It will live beyond you. Okay. Unless you shut it down yourself. So you can actually close it yourself. But as a result, it does have to file annual reports. It depends where you're incorporated. So you can incorporate federally or provincially. That will determine the level of reporting you have to do. You generally want to be maintaining a minute book. So every year you need to review your financial statements and approve them. You need to confirm whether there's any dividends from your corporation. And then it's going to have annual tax returns. And a corporation can have any year end you want. So, your personal tax year is always going to be January to December. Your corporate tax year, whatever you want. So when you're choosing your year end, I always say to people, base it on what works for you, right? Like if you're a toy store, you probably don't want your year end November 30th because you're probably busy in December trying to sell toys. So pick a year end that works for your business. And then if you don't really care, pick the one furthest away that you possibly can. That's kind of the advice I give. So I just see a question there. What is the difference between Inc., Corp, and Limited? There's actually no difference. It's just in the way you name your company. So I can name my company, Cara Chesney Butterflies and Sunshine Inc., Limited, Link, or Corporation. It's just a naming thing in Ontario, typically. All right. Any other questions so far? All right. So one thing people always say to me, so they come in and they've gotten advice that they should incorporate, and they're going to do it because they're going to save lots of money because dividends are cheaper. So again, I'm going to give you a really simple example. I actually draw pictures when I meet with clients, and I draw the box and I draw the stick figures. But so the way salary versus dividend. So you're right. When you're a shareholder in your company, you have two ways to take the money out, salary or dividends. Okay. And both of those are taxable. So if you take a salary, company makes $100. Okay. So, it has revenue, it has expenses, its net profit is $100. You take a salary of $100. Company makes $0 now. So a salary is a deduction. So 100 minus 100 is 0. You take, me, the person, I get $100. I'm going to use the lowest tax bracket to keep my math simple. I pay $20 in tax. So I've got $80 in my jeans pockets to go spend. Okay. Dividend. Company makes $100. It pays $12 in tax first. So now company has $88. Okay. I take the $88 out, and as a person, I'm going to pay $8 in tax. So between me and my company in both situations, $20 of tax got paid, right? Salary, I paid it all. Dividend, Corp and I shared it. $20 of tax get paid, and in both situations, I have $80 left. So as a person. So and that's in Ontario, we are almost perfectly integrated. So dividends are about 0.01% cheaper. Okay, but in general, that's called integration. It just means I'm indifferent between salary versus dividends, except for the reasons I'm going to talk about. So I don't really care which one I take, right? Because I won't pay more or less. Some provinces are not perfectly integrated and dividends can be a little bit cheaper, but in general, most provinces are perfectly integrated. So again, don't care. The only reason I might care is if I have lots of other shareholders and I want them to take a salary and me to take a dividend. But in general, you're going to have some kind of shareholders agreement to protect that. But if it's your business and it's you owning it with, say, your close family members, don't really care, dividends versus salary. So the only difference between this is salary will attract CP Canada Pension Plan. Dividends do not. So there is a cost to Canada Pension. So if you take a salary from your corporation, in 2021, the Canada Pension cost is 5.45%. Your company has to match that. So you're looking at an 11% cost for Canada Pension. And that, but in theory, you're contributing to Canada Pension, so you'll be entitled to more when you retire and you collect it, right? So it's kind of forced retirement savings. If you're currently self-employed, you are already paying that Canada Pension, and you're actually paying both sides of it. So in your tax return, have a look if you're self-employed, because your total tax bill shows at the very bottom, and people focus on that. But in that number is your Canada Pension contribution. And you're doing both the employer and the employee side of it because you're self-employed. So, and again, if you do salary, you will have to pay Canada Pension. Salary creates RRSP room. Dividends do not. So a lot of my clients, actually, we do pay them some level of salary because I want them to have RRSP room. I want them to have multiple buckets that they can put their retirement savings in. So we will often pay them a salary. And then if you have something like a childcare deduction, childcare is only deductible against salaried income. It is not deductible against dividend income. So again, sometimes we pay someone a salary so that we can deduct that very expensive childcare. With salary as well, your corporation will make those remittances on your behalf. So similar, if you've ever been employed and gotten a T4, you know how your salary might be $50,000, but you never actually get $50,000? It works the same way if you're incorporated. Your corporation will remit your taxes on your behalf, remit your CPP on your behalf. Okay. Any comments about that? No. So in terms of dividends, oh yeah, go ahead.
There were a couple questions, Cara. Yep. From Mary, how often within a year can you take a dividend?
As much as you want. Yeah. So there is, at the end, so this is the month right now. So a T5 is what's issued when you've taken a dividend. T4 is what's issued when you've taken a salary. You can take a mix of salary and dividends. Some of my clients, we do both. And there's planning reasons behind why I would do that. But those T4s and T5s are due with the Canada Revenue Agency by the end of February. So that's what I'm working on right now. Most of my days are filled with filing my clients' T4s and T5s.
And Rita also asked, should your company name be the same as your website? I'm not sure if that's more of a legal question or.
Yeah, I don't know. I mean, once you've incorporated an entity, so if I've called, Cara Chesney Sunshines and Rainbows, no one else can use that name, right? You can protect a name other ways, but a corporation is generally the easiest way to do it. The reason behind that is when you incorporate, they do a name search and they make sure there's not another name similar. And so no one else can now incorporate and call themselves Cara Chesney Sunshine and Rainbows. So I think, to the extent that they're the same name, I think it gives you a little bit more protection. But I don't know in terms of like trademarking a website. Yeah, beyond that. Okay. So I talked about this already a little bit. Your corporation's going to have to do some level of bookkeeping. Your corporation's going to have to file a tax return. You do have to maintain all the corporate records. So the rules in Canada are, and it's the same for personal, is you have to keep your supporting documents for 6 years from the date of your notice of assessment. So that's why you always hear the rule 7 years. So if I file, my 2020 tax return, I file it, April 1st, and I get my notice of assessment from the CRA on April 30th. I have to keep it 6 years from that date, all the backup to go with my return. And you need to keep, invoices, deposit slips, contracts. It can be electronic. So the CRA will accept, if you get in an audit, the CRA would accept electronic copies of those things or reports you can pull from your sales system. So you don't have to print everything and keep it in paper. So I talked about the 6 years. So right now, if you're self-employed, all you're doing is essentially including your net income on your tax return. So you're putting your revenue and you're putting your expenses. When you're incorporated, you actually have to do a full set of financial statements. So you need to tell them, this is what my cash about, if my year end is September 30th, this is what my cash was on September 30th. This is what my inventory was on September 30th. This is what my equipment was. This is what I owed. These are the payables I had. So you're going to have to do a balance sheet and an income statement. And most company, most of my corporations, we do what's called a notice to reader. So we compile the information, we prepare a balance sheet and an income statement that goes to the CRA. So it's more work, to be honest. It's more work for your accountant or for you, because you're going to have to do that reporting at the end of your corporate year. Okay. In terms of tax filing periods and deadlines, so if you are self-employed or you have a partnership that goes on your personal return, taxes are always due April 30th of the year after, unless you have to do installments, but April 30th. You actually can file your personal tax return on June 15th. So if you have self-employment income, your deadline for filing is in a non-COVID year, because last year everything was September. It was like the tax season that never ended on my world. But so typically you have to file by June 15th, but you owe on April 30th. So I always work to the April 30th deadline, because if you owe, we need to know by April 30th. And the interest rate charged by the CRA is about 6%. So it's not a credit card interest rate, but it's not ideal. When, as a person, you owe more than $3,000, so I file my 2019 return, I owe $3,000. I file my 2020 return, I owe $3,500. The CRA will generally ask for installments the following year. So in 2021, I'll get a letter saying, last year you owed $3,000, so we want you to pay $1,500 in September and $1,500 in December. They assume that you're going to make the same amount, and they want installments. They want to treat you like they would treat an employee, right? Because an employee, their taxes are going to the CRA every month. So as a self-employed person, they want your taxes up front, like they do for employees. You can choose to ignore that. The interest rate is 6%. If you have a bad year, right? Like sometimes I have my clients call and say, I was on parental leave this year. I didn't make any money. Well, we ignore the installments because they're not going to owe. So it's something you can look at and visit. Corporations in their first year will not make any installments. They're not required to. After that, then they will be required to make installments the same way you would be required as a sole proprietor. So you'll get an installment. It's either quarterly or monthly. Both are calculated based on the previous year's earnings. Again, if we thought the earnings were going to be lower, I had a client yesterday who retired in December. The CRA wanted $14,000 a month in installments. Well, there's very little. This is corporation. Well, there's actually not going to be very much income this year. So, we calculated, we ran an estimate, and I told him, pay $1,000 a month. So, anything else? I talked about interest. Corporations. So same as how I talked about that April 30th and that June 15th deadline. Corporation taxes are due 90 days after their corporate year end in most cases. Some it's due 2 months after, but most it's due 3 months after. But you don't have to file your return for 6 months. But again, if you owe a whole bunch of money, they're going to start charging interest after 3 months. So why always work to the 3-month deadline? Unless for some reason, we thought you'd paid a lot of extra tax this year, but you have a 6-month deadline to file the tax return, 3 months to pay. So I see a question there. What's the difference between corporate tax return and corporate taxes? Really nothing. The corporate tax return is, so on your corporate tax return, we put your income, we put your balance sheet at the year end, and then the corporate tax return will calculate the taxes owing, if any, right? If I paid installments during the year, so maybe it's calculating that my tax expense is $30,000, but I paid $30,000 in installments, I don't owe anything, right? Or if I had maybe I got like in COVID, some businesses actually are getting refunds because they've paid based on last year, but they've had less sales this year. All right, this is the last slide. So if you're thinking of incorporating, one of those reasons is triggering with you, and you're like, yep, I'm making too much money, or I want to access those shred credits. So these are the structuring considerations you should look at. So who do I want to be my shareholders? So key thing here is your shareholders, you're stuck with them in most cases. So think about that one hard. Because, do you really want someone that you don't really like that you now have to run this business with, who's now entitled to your financial information, right? So who should those shareholders be? Who should be able to vote? So we have multiple kinds of shares that you can issue. And think of when you issue shares, think of it like you bought shares from Royal Bank, right? That's what you're doing here. You're creating a box with a company. And then you can decide what kind of shares to issue. So do you want these people to have votes? If it's your business, you're going to want voting control, right? Do you want them to have votes? Do you want them to have growth in your business? There's typically two kinds of shares. So we have common shares. Those guys are going to be entitled to growth. So if I have 50% common shares in my business, I'm going to be entitled to with my business if I sell it later. Preferred shares are typically almost like debt in a way. So sometimes you'll issue preferred shares. I'll issue $100,000 of preferred shares at 8%. So, and those preferred shares are generally redeemable for $100,000 and pay 8% in like interest. So we can bring on shareholders but they have no voting rights. They're called preferred because if the company goes bankrupt or it dissolves, preferred, they get their $100,000 first before any common shareholders get anything. So it's a bit like secured debt. Do you have any businesses or assets to roll into the corporation? And so I think this is kind of one of the questions that maybe Liz had. This is what happens. So I'm self-employed and I have, some equipment and I believe my business has goodwill, like it's valuable, I could sell it. And now I'm going to incorporate. So what I'm essentially doing is I'm selling my business, I'm selling my goodwill, I'm selling my equipment, I'm selling my inventory, and I'm selling it from me, the person, to the box over here. That is a taxable event. So that in theory, I would pay tax on that. So say my business, I started it from the ground up and now my business is worth $500,000. I'm selling everything for $500,000 to my company. I have a capital gain for $500,000. Not great, right? So in that situation, there's what we call a rollover provision, and it's a tax thing. And so what happens is my business is worth $500,000. I roll it in, just a fancy way of transferring everything over to my box of my corporation, and I take back shares with a value of $500,000. So it basically turns that transaction into it's non-taxable on the day it happens. I will eventually pay tax on that $500,000 someday, because eventually I'm going to sell my business or I'm going to pull money out of my business and I'll pay tax out on it. But it prevents me from being taxed on it today, if that makes any sense at all. So that's called a rollover. We usually do it as what's called a Section 85 rollover. Do you want the ability to pay dividends to multiple shareholders? So if you make everybody Class A common shareholders, you bring on 10 shareholders, and you're all Class A common shareholders, and you all own 10%. Every time there's a dividend, there's a $100 dividend, every single person's getting $10. So as a tax person, I don't love that because everybody has to take the same dividend. But what if you worked as a professor this year and you made $200,000? I don't want to add $20,000 to your income for your dividend, right? So, do I want the flexibility to pay some shareholders certain dividends without paying everybody? As a tax person, yes, I do. But as a lawyer, if I were a lawyer, you want to protect everybody, right? You don't want one person taking all the money and everyone else getting nothing. So it's a decision you have to make. But you're going to have multiple classes of shares in order to be able to pay people different dividends. Are you regulated professional? So some professions, so just to give you an idea, one of my corporations is a professional corporation. I am not allowed to have other shareholders. I'm the only one who can be a shareholder. So you got to look at that if you're in any kind of regulated profession. Do any of your proposed shareholders, so do they own other shares of other Canadian small business? So CCPC, Canadian controlled private corporations. So remember that $500,000 limit? So you pay 12.2% up to $500,000, 26.5% above that. If some of your shareholders have shares of another CCPC, you guys may have to share that $500,000 limit. So, if myself and my partner, each have companies and we own shares in each other's, I'm going to have to share that $500,000 limit between the two companies. So that's a structuring consideration. It is a question you should ask yourself before you decide who your shareholders are going to be. The other thing that's actually not on here is look at citizenship of your shareholders. So generally, if anyone in your proposed shareholder structure is a US citizen, we generally try and avoid them being shareholders in a Canadian corporation. There are two countries in the world that tax based on citizenship, the US and another country. I can't remember the name of it. U.S. taxes based on citizenship. So if you were born in the United States and you have a U.S. you're a U.S. citizen or you have a green card, you're going to file U.S. taxes for your whole life forever, unless you relinquish. Doesn't matter where you live. Doesn't matter if you were in that country for 5 minutes. Okay. Every other country doesn't tax that way. So in Canada, we tax based on residency. You can still be a Canadian citizen, but you can be a non-resident. You can be a non-resident living in the United States. Never file. Once you break ties, you never file a Canadian tax return again. You should look at citizenship, and if they're U.S., this can be a problem because you can end up in double tax. So just something to warn you about. Should you be pursuing shareholders with U.S. citizenship? There's other countries that can be a problem too, but most are not an issue. Do you need a trust or a holding company? So that can be for a little bit for legal protection. I'm not going to get into that too much, but should be something you think about. Do you need a shareholder agreement? My honesty, most times, yes. If it's you and your partner doing this together, so you're married or you're in a common law relationship, anything you put in a shareholder agreement is going to get negated by family law anyway. So I often don't have it when it's spouses. But if there's any third party, you're not going to need a shareholder agreement until you need it. You're not going to need it at the start because you all love each other, right? 10 years from now, when you hate each other and you never want to see your partner again, you need a shareholder agreement. The shareholder agreement deals with, what happens if one of us wants out? What happens if one of us dies? Who's going to inherit their shares? Like, do you want to work with their 14-year-old child or their 18-year-old child who spent all their money? Like, that's who you're going to get stuck with if you don't have a shareholder agreement to protect you in the future. What happens if we disagree? What happens if we wanted, our shareholder agreement will cover sort of the main situations where it can go bad. So it'll give you guidance on what happens. What happens if I want them out? I don't like them anymore. Who buys who out? What happens? How do we value this business? Okay. And then the last thing here is, do you need an employment agreement? So generally you would put in place an employment agreement between you and your corporation, just to establish that employment relationship. I mean, again, if you're the sole shareholder, you can do it. You can change your employment agreement every week if you want, right? You can change your salary. The clients say, we often set my client's salary for the year, and then life happens, right? They're like, oh, I'm going to go on maternity leave, or I got this other job over here. We can change that. You're not stuck to whatever you decided in January, right? Some of my clients, we change their salary monthly. Depends on how the business is doing, right? But it's a little harder to control what happens. But I would recommend a shareholders agreement, and I do not do them. So that's a lawyer. And a good shareholders agreement is not insignificant. They're not cheap, but you're going to need it if you don't have it and something goes really bad, you will regret not having paid the money.
Cara, just before you go to the next slide, which we're at the questions, that's timely, but there is a question from Sheila. I'm not sure if you want to scroll up, but I can read it. Is incorporation the only way your personal assets are protected? If you hire independent contractors and those contractors get hurt on the job and the contractor sues based on injuries, are my assets safe now that I am incorporated?
In a corporate situation, so generally, yes, your assets would be protected as long as you did everything you're going to be a director of your own company, right? So if you incorporate your entity and you're a director, and then you were like, well, I'm just going to ignore all the safety rules that I'm supposed to follow, then you're going to kind of pierce the corporate veil, right? Like, that contractor can still come after you because you were a director of the company and you didn't put in place all the safety that you were supposed to put in place under it doesn't protect you from being a bad employer, or do you know what I mean? But generally, your assets would be safe if you're incorporated. The other thing is, if you're not incorporated, have a contractor agreement that says, who maintains the insurance. If you're a contractor and you're on my site and are you going to make them have WSIB? If they're on your site and they do something they shouldn't do, who's responsible for that? Whose insurance should pay, right? So your contractor agreement would generally specify that. If you're dealing with like a contractor who's building a building, there'll be an agreement that says this is who's responsible for what, right? The next one, I am an incorporated company with no shareholder except myself. Do I need to maintain a minute book? Yes, you do. Yep, can be electronic. Your minute book should document, You should have your articles of incorporation. It should have your share certificates, who is the shareholders. You should have an annual meeting every year to approve your financial statements. You should include dividend resolutions to say, I've declared this dividend on this day. But yeah, you do. And I am actually running into a problem right now where a client incorporated themselves and there's no minute book and they're trying to sell the business. The deal's going to fall through because they're trying to sell the shares of the business and there's no minute book. So as a buyer, if there's no minute book to document everything that's happened over the history, it's almost like the company doesn't even exist. It's a problem. They're trying to recreate it from scratch, and it was incorporated in 1994. So, yeah, that was. I got brought in. That was not a client of mine. I got brought in to help on the sale, to give tax advice on the sale. And I said, and the lawyer is saying, "Where's the minute book?" And they're going, "There is none." So. Business Law Clinic, those guys are great. So I actually do a similar presentation for them. What is the cost of incorporating? That's a good question. It depends on how complex it is. So if it's you with your share, and the lawyers would do that generally. My firm does have the ability to do some. We have some legal team. We have a legal team on staff, and just to give you an idea, the minimum charge I think for us is about $2,500. That includes the tax planning and tax advice and who should be what shareholders from a tax perspective as well. But generally in Kingston, I think the price is around $2,000 to $4,000 is the typical average. A shareholder agreement on top of that. So a shareholder agreement I've seen anywhere from $5,000 to $15,000 if you need one. And again, the more shareholders you bring in, the more complicated it's going to be. Next question. What are considerations for having multiple businesses under an incorporation? So I presume you're getting into like a holding company structure. So I wish I could draw pictures for you, but a holding company up here, and you might have multiple companies underneath. Okay, so corporation A, B, C, D, holding co. There's multiple reasons we would do that. One of the most common is what's called purification. So if company A is a pharmacy and company B is a contractor, like a construction entity, and company C is a dental office, I'm making this up because the dental office wouldn't be in that, a retail store, and now the contractor's building up lots of cash, or the pharmacy's making lots of money. Now it's got all this cash in here, and remember the construction company could be liable if something happens. So we might have a holding company above it, and it can pay the money. It's called creditor proofing. It can pay the money up to holdco as a dividend. If it's structured properly, that dividend is tax-free. And it gets the money out of construction co, so that if I get sued, there's nothing in there. There's not $1 million of cash. That's a common way. That's a common reason behind it. It allows more flexibility in terms of lending money between the companies, or if you're starting up a new startup over here, you can dividend from the profitable company up, and then holdco can lend it over. Those are some common reasons we do it. It's generally there's generally a legal or a protection type reason we do it. Can you buy stocks with income from an incorporated business? Yeah. So your company makes money, right? And now it's got all this extra money in it. It's got $1 million of extra income, which would be fantastic, right? It can generally that company can make investments. So it can open its own investment portfolio. It can buy $1 million worth of stocks, bonds, potentially you might buy a rental property, right? But everything in there is going to be subject to risk. Everything in the box, if you get sued, is at risk. But yes, you can have an investment portfolio. And we do that to help you save for retirement, right? If it's your business, your RSP room is all filled up. You're capped out on RSP room. You only get so much a year. Then the next step, once your RSP room is full, we generally look at buying investments inside your business.
Thanks, Cara. And I see that we're already at our time, and I know that Cara has other obligations to go to, as I'm sure many of you do as well. So her contact information is right there on the screen. I'd suggest that you reach out, and you might have to set up an appointment with her. But I want to thank you, Cara, on behalf of us all, because this is Not a simple topic for those of us who are new to it. We appreciate you putting it into terms that we can understand with the great slides. I'll just reiterate, anyone who would like a copy of today's recording, just reach out to me. My email is in the chat, or you can respond to the Eventbrite link that you received as well. Thank you so much for joining us. Have a great day, everyone, and happy accounting and incorporating in the future. Take care.